Hey guys, this is Rudy coming to you live from Palm Beach in Florida. It is March 16th. It is Sunday. I had a little bit of free time today, so I thought I'll put together a little presentation on energy and answer some of the questions from the people on our channel. What I want to do is kind of just walk you through it from a risk tolerance point of view. Obviously, over the past couple of weeks or so, we've seen the market tank. Let's take a look at some of the reasons why that happened and then take a look at some of the energy stocks that are winners and losers. And as I said, I'm going to try and answer some of the questions that some of the people asked me on the channel. So the first thing here is, and I've spoken about this many times before, is XLE, right? So XLE is a spider ETF. An ETF is an exchange traded fund. It's an easy buy. You can currently buy it at about $90. It's been at or around $90 for the past 1 year or so. It's traded higher. Obviously, it's also traded slightly lower. A couple of things to look out for you when you look at XLE as a potential stock that you want to buy. Firstly, if you think of XLE as a component in the S&P 500, the energy sector, or XLE specifically, is only 3.4% of the entire S&P 500 sector. So it gives you a sense of diversification. One of the reasons why I like energy is because we consume it every single day, and we consume a little bit more than yesterday and the day before and the day before that every single day. So it's a slow growth trickle, right? You can just do better and better and better over time, but you have to be patient. Other things to look out for here is the expense ratio. If you're buying an exchange traded fund, obviously there's a fund manager or fund management team. How much do they cost you? Well, they cost you 0.08%. So it's fairly inexpensive, and it's an inexpensive way to play the energy market. Whether it's right for you or not is a separate issue, and I'm going to try and sort of address that as we go. Now, the first thing to do here is, if we look at XLE, the energy ETF, over the past 1 year, it's been more or less flat, even though it's had some, peaks and valleys. And if you look at the black line over here, that's the S&P 500, which has outperformed the energy sector quite comfortably. But the reason for that has been primarily because of the so-called Magnificent Seven, right? So you have seven stocks in the S&P 500 that have carried the market. If you scoop out those seven stocks, the S&P 500 performed at a very tepid 3 or 4% for the entire year. But these seven stocks that I've highlighted for you here are the ones that actually drove the growth in the S&P 500. Otherwise, the line would have looked pretty much the same as XLE over the past 1 year or so. This drop off that you see over the last few months or so has been as a result of the pullback on a couple of stocks. Obviously, some of them have taken a tumble, like Tesla is down about 50% from its high, and others have pulled back quite sharply, including NVIDIA, the sort of S&P 500 darling over the past 1 year or so, or a couple of years actually, since 2003. Semis, AI, so a number of reasons why it flew high, and not really any particular significant compelling reason why it pulled back so sharply, but it has pulled back quite sharply. Anyway, back to XLE. The fund has a value of over $30 billion, so it's not small by any means. It pays a dividend yield of about 3%, and lots of volume traded. The reason why volume is interesting or important is because it gives you an idea uh, as to the liquidity of the stock. So if you buy a particular stock like XLE, it's easy to trade in and out of it. For the people who are day trading, I mean, you can buy it, and then after a nice spike like we saw on Friday, you can always exit again and then go again, in however it is that you do that. If you look at XLE as an index, approximately almost 40% of its stock is in two particular equities, about 23% Exxon and about 16% Chevron, so it's about 39%. If you look at those two stocks individually, Exxon was outperforming Chevron quite easily for several months, and then pulled back sharply. As the energy sector pulled back sharply, Exxon pulled back more than Chevron, and now they're kind of been flatlining and more or less trending equal again. You can see that at the bottom here over the past 1 year. Exxon is basically flat, and Chevron up 1%. Both of them pay a decent dividend of over 3%. So if you take that into consideration and you're reinvesting your dividends, you up just a smidge, right? Not much, but just a little. But what I want to do today is dive one level deeper on XLE. And instead of looking at Chevron and Exxon and XLE itself, I want to look at some of the top 5 holdings that they have in their top 10 outside of Exxon and Chevron. So specifically what I'm going to do is I'm going to cover ConocoPhillips, EOG Resources, Marathon, Schlumberger, and Williams. And I'm going to put them in alphabetical order like this on the chart so that you can easily keep track if that is what you're trying to do. But before I do that, I first want to talk about the sort of proverbial elephant in the room, and that's Occidental Petroleum, because many of you still know me as Mr. Oxy. And Supernova Giacomo said about a day ago, "Good morning, Mr. Oxy. Thoughts on the recent email from Occidental to exercise the pandemic warrants?" Now, of course, many of you will know that a few years ago, Oxy gave us all some warrants, which is sort of in the form of a dividend. So all the stockholders at that point in time got one warrant, so received one warrant for every 8 shares that we held of the common stock. Now, those warrants were issued and gave you the ability, basically, it gives you the right to buy Occidental Petroleum at $22 per share. Now, of course, with the current stock price at around 46 bucks or so, it's not a bad deal because you can actually buy Oxy for $22. If you purchased warrants, remember that gives you the right to buy Occidental for $22, then your purchase price will be the cost of whatever the warrant was plus $22. If you receive the warrants as a dividend, so in other words, if you had common stock and they were just given to you, kind of like a payout, like a dividend payout, then your cost of the warrant basically is effectively zero because you got them for free because you were an investor. And it gives you the ability to exercise those warrants at $22. Now what they've done is Oxy sent a notification out to all their dividend holders saying that any of the warrant holders have the opportunity to exercise each of their warrants at a temporarily reduced exercise price of $21.30, right? So $21.30, which is a 70-cent discount from the actual exercise price that they originally offered, which was $22. Now, why would they do such an interesting thing? And why would they even discount the warrants, which are already effectively well priced anyway? Well, Oxy is hoping that a number of people will take them up on the offer. Of course, not all the people who own warrants are going to exercise them, but if they all did, then Occidental would receive gross proceeds of approximately $1.6 billion. In other words, Occidental wants money. And the reason why they want money is because they say they will use the proceeds of this general for corporate, they will use the proceeds for general corporate purposes, which may include redemption or repayment of certain of its outstanding indebtedness. Redemption, which typically means bonds, and repayment means debt, right? So some long-term liabilities may be repaid, and some bondholders will have a redemption offer as well from the proceeds that they generate. Now, why would they do that anyway? Well, Oxy has been a horrible performer in the stock market. In fact, it's underperformed most of the energy stocks. So other than for the fact that Berkshire Hathaway still owns a fistful of Occidental shares, in fact, he's the largest shareholder, institutional shareholder, Berkshire. When I say he, I'm obviously talking about Mr. Buffett. It has not been performing well at all. You can see over a 1-year period, the S&P 500 was up about 9%, Oxy was down 24%, and even over 3 years, the S&P delivered 35% and Oxy negative 13%. So if you were holding Oxy long and you're still holding Oxy long, you're probably not in a very happy space right now. You may as well just have bought the S&P 500, which is something like SPY. You just hold the whole index and you'd probably be okay. How is Oxy doing? So this is its chart over the past 1 year. It's down 25.65%. You can buy currently for about 46 bucks. It's too expensive. I wouldn't buy it here for $46, not even with your money or not even with Berkshire Hathaway's money. The PE ratio is about 20. So priced a little bit too high. One of the reasons why it's priced a little bit too high, TTM means trailing 12 months, is because the earnings per share at 226 on a trailing 12-month basis. So PE is price earnings as a ratio. So the price of the stock is $46 and the earnings is 226. And as a result, you end up with a PE ratio of 20, which is a little bit too high. So based on its earnings, the stock price should actually come down a little bit more if you wanted to buy it. You could wait a while. You probably see it pull back a little bit more, unless all the energy stocks suddenly spike or WTI futures suddenly spikes, because then Oxy will just ride that wave and the stock will trade higher too. You don't buy it for its dividend. It pays a dividend. For dividends of only 96 cents, it's currently yielding only 2%. Not really worth buying purely for the purposes of holding it for dividends. So, like I said, I wouldn't buy Oxy here with your money, and probably not even with Berkshire Hathaway's money. So, Mazar Sophie 5270 a few days ago said, no, 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 you are Mr. Oxy, not Mr. XLE, right? So Oxy at one stage was in the top 10 of XLE as well. It's not currently, they're not holding it. I don't think it's in the top 10. I'd have to check and make sure, but I don't think it's there. It's trading at $45. He's basically saying, should I buy it? Um, so I don't know, man. I said to Mazar, Oxy was a buy at $10, right? So for the people who've been on our channel for quite a few years now, uh, yeah, you should have bought Oxy when it was trading in the teens, 10, 12, 15, $18 or whatever. Not at Berkshire's cost basis of about $60. The thing that makes me most uncomfortable about Occidental Petroleum is that Berkshire Hathaway, as the largest institutional shareholder, can drop this, the stock like a ton of bricks, and Oxy will just crash. And he can do that anytime he wants, right? This is not your typical sort of institutional investor like a BlackRock or a State Street that is kind of just holds some of these stocks almost indefinitely, right? So, yeah, I don't know. I, I'm not comfortable with Oxy. So let me go back to these five, right? So I'm going to talk about Conoco, EOG Resources, Marathon, Schlumberger, and Williams, and get off the Oxy soapbox for a little while. So I've gone to bar charts here to do a five side-by-side comparison analysis for you briefly, just to give you a bit of a summary. The volume you can see also is there's a lot of stocks being traded here. So a little interesting note that I've highlighted here for you in green. These two stocks are trading sort of at a similar price, Marathon and EOG, so 120, 130 respectively. But the volume on EOG is almost 2 times that of Marathon. So lots of volume traded on EOG Resources. I'm not sure exactly why. I haven't done a deep dive on any of these, but I'm going to share some information with you as we go. Look at the volume on Schlumberger, 13 million shares traded per day, and this is a $40 stock. It's a large volume, right? These five stocks, by the way, are energy stocks that are included in the basket of XLE stocks, but they're not all the same, right? So ConocoPhillips is US integrated, EOG is US exploration and product. Sometimes you'll see those E and P. And Marathon is refining and marketing. Schlumberger is oil field services, drilling and wells and things like that. And Williams is production and pipeline. So these things are not the same. So when you compare them side by side, to be fair, you're not comparing the proverbial apples with apples, right? So let's take a quick look here. The 20-day raw stochastics for all you technical nerds shows us that, remember, if it's 80 or above, it's getting close to being overbought. And if it's 20 or below, it's getting close to being oversold. So ConocoPhillips is very close to being overbought here. That's why I put a red arrow there. And the two green ones, EOG and Marathon, might be a better buy than ConocoPhillips right now if you are hoping to open or enter a new position in any of these stocks. Williams, interesting one here because the price earnings ratio, because Williams has spiked so much, right? So the price has gone up so high. The price earnings ratio for Williams is now nearly 30. So it's not priced to buy at all. The others are much more reasonably priced. So we've got a PE ratio on Conoco of 12, EOG at 10, Marathon at 14, Schlumberger at around 12 or so. Interestingly enough, the analysts are all saying buy Williams. I would take the other side of that equation and say now is probably the time you want to sell and take some profit on Williams, because it's been on a run and it's been doing really, really well. The analysts are saying 100% sell on Marathon. I'm not too sure about that. In fact, when they say sell, then it's probably the time for us to potentially nibble just a little bit. So what I'm doing here is I'm looking at the fundamentals and I'm taking the annual sales and dividing it by the market cap or market capitalization or market valuation. In case you've forgotten what that is all the outstanding shares multiplied by the current share price. So if I look at the actual individual stocks, so just on the left-hand side, you look at ConocoPhillips, it's generating annual sales of around $56 billion per year, and it has a market cap of $125 billion, 125.26. If I take the market cap and I divide the annual sales. So annual sales divided by market cap is about 45%. Look what happens when I do the same thing with Marathon Petroleum. It is generating more than $138 billion in sales on an annualized basis, and its market cap is only $44 billion, right? So this is a very strange anomaly here. This is kind of weird. So the others are sort of more normal. When you see these type of anomalies and you want to buy Marathon Petroleum as an example, that's a good time for you to do a little bit of a deeper dive and see exactly what it is that's going on here. By the way, the reverse is true here because Williams is basically generating $10 billion, $10.5 billion in sales, but the market cap is super high. So as I said, the market cap is the all the outstanding shares multiplied by the current share price. The reason why this number is so high is because the stock price has just spiked. Williams has just gone through the roof, right? The other thing that you can also look at here is the dividend date. They all pay a fairly decent dividend. And the only one that has an ex-dividend date in the future is EOG Resources. If you own the stock before April 16th, you'll get the next dividend when it is declared and paid out. If we look at them individually, which I'm going to do very briefly here, you can currently buy ConocoPhillips at around $100 for the over the past 1 year or so. It's down about 17%. The chart looks horrible. The PE ratio is nicely priced. It's pretty good, and it pays a dividend of over 3%. So it's not a bad buy here. I think Conoco, if you have the risk tolerance to add this to your portfolio, probably not a bad time to get into the stock. EOG Resources, on the other hand, has been flatlining, but look at the volatility, right? So it's got a green chart, but huge peaks and valleys. The price has pretty much been, relatively speaking, flat over the past 1 year. It is literally flat, 0.11%. And you can see that the range has been quite narrow too, right? So over the past 1 year, the high has been sort of just over $135, and the low has been just under $120. It's also got a very attractive PE ratio of only 11, and it also pays a nice dividend of 3%. EOG is potentially a buy as well, or at the very least, you can add it to your watch list. Marathon Petroleum, over the past year, down 25%. The chart looks horrible. The PE ratio looks okay at 14. The dividend is okay at 2.5. An interesting one. This one has taken quite a tumble over the last year or so, kind of like Oxy, potentially maybe a buy or add it to your watch list. Schlumberger, over the past year, down about 23%. The chart looks horrible as well, obviously. The dividend's okay, 2.77. The PE ratio is okay at 13. I don't know. Not too exciting, right? Williams, this one is one that you can certainly avoid. You can buy it currently at $57. If you own Williams and you've been riding this nice wave that it's been on, now is probably the time to take a little bit of profit. I don't see too much upside from here. Over the past year, it's given you a gain. If you were long Williams companies, congratulations and well done. If you've benefited from this 55% gain over the last year or so, as I said, maybe take a little bit of profit. You can always park it somewhere else, maybe buy some Conoco or something that's trading low and ride the wave on that one as it goes back up again. The PE ratio is too expensive, 31. Trailing 12 months is just too high. Dividend is nice, 3.4, so 3.5% dividend. And of course, the chart looks great. Can it hold this price or grow from here? Tough one. This is a pipeline company. I have a couple of pipelines. I have Energy Transfer and Enbridge in my portfolio. They haven't done as well, nearly as well as Williams companies. So on one hand, you could say I missed this one. And on the other hand, you could say, well, I'll wait for the uptick in the ones that I currently hold because they're going to bounce again pretty much the same way. You get these peaks and valleys. You get it on all stocks, right? So if we look at them side by side in picture form, here's the performance. So Williams, so down here at the bottom, you can see that 54%, right? Williams has outperformed the others easily, very well. EOG was flat. And these three laggards here have been the worst performers here, right? So what I do typically is I'll add these like ConocoPhillips, Marathon, and Schlumberger to my watch list, and potentially maybe buy into one of them. Like I did recently, if you watch some of my videos from earlier this year, I added I actually added some Exxon anyway, just sort of in my savings account as one of my sort of fundamental holdings. I'll just hold it and just keep it. And the other one that I added that was a grossly underperforming stock was Phillips 66, which is also in the top 10 XLE holdings, right? Um, if you add up these five, so if you look at the holdings here on the right-hand side, the largest XLE holding for the fund was Conoco at 7.66%, uh, which fortunately for the fund manager wasn't the worst performer. The worst performer on this little list here is Marathon, and Marathon was the smallest holding, 3.3. But if you add them up, these five stocks is 24%. And you might remember when I started this video, I talked about Exxon and Chevron, and that's about 40% of XLE. So this is another 24%. So now you got almost 65% of XLE just in these seven stocks that I've spoken about today. So what do, right? So the first thing that you need to do is you want to say to yourself, like, the first question you want to answer is, do I want to even buy energy stocks, yes or no? For me, this is like a no-brainer because, as I said earlier, energy is something we consume globally on a massive scale. Every single day, we just use a little bit more than what we used the day before. So for me, this is kind of like a no-brainer. Energy is an easy buy. But then what do? You say, my risk tolerance is low, right? So this might be related to your current age, whether you sort of near the proverbial retirement or not. Are you still working? Are you earning a regular income? What are your family commitments? What are your liabilities that you have to, sort of accommodate? Maybe you have mortgages, you have car leases, and all kinds of stuff like that. If you have credit card debt, get rid of that as soon as you possibly can because that's horrible debt. It's bad debt. But these are questions that only you can answer. So if your risk tolerance is relatively low for whatever reason, you could just buy the index and just buy XLE. If you have medium risk in terms of risk tolerance, then you can say like, okay, you know what? I would like to own some single stocks. So I'm maybe a little bit less risk averse in terms of owning single stocks. So rather than buy XLE, I'm going to look for some upside here and buy, for instance, of these two. Exxon has been underperforming compared to Chevron. So I'm prepared to take or accommodate a little bit of single stock risk. So I'm going to buy some Exxon. What you could also do is you could mix it. You could say, I have X amount of dollars available. It doesn't matter what the amount is. So let's say you have $500 to invest. You could say, I'm going to put $250 into XLE and $250 into XOM and kind of diversify it a little bit that way. Well, otherwise, you can say, I have a much higher risk tolerance, and maybe that is because you are younger, you have an income that easily meets or matches your spending requirements, plus it gives you a significant amount of money to still carve out and invest for the future. And you can say, I'm going to rather invest in a basket of energy stocks and kind of build your own ETF, right? So instead of buying the ETF like XLE, you just build your own basket of stocks. And you say, I'm just going to build this little basket of higher risk stocks, and I'm going to buy some of the underperforming stocks like Marathon and Conoco and Occidental or whatever, and wait for the upside on that. And be prepared to hold it then for, if you're holding it long, for 3 to 5 years or so. So we don't want to trade in and out of these positions, because the worst thing that you can do is try and time the market. And the second worst thing that you can do is when the stock pulls back is exit the position and take a loss, because there are only two rules here, quoting famous investor Mr. Buffett. Rule number one is don't lose money. And rule number two is don't ever forget rule number one. So that is sort of in a nutshell, a little bit of an energy overview. Depending on your risk tolerance, what is it that you want to invest in? How much do you want to invest? What do you feel most comfortable doing? Do you want to buy an index with a fund manager trading it for you and pay them 0.08% as a fee? Or do you want to capture a blend of that and maybe buy a little bit of XLE and some Exxon and Chevron or whatever and diversify that way? Or Do you want to go with a higher risk option and buy some of these underperforming stocks and wait for the upside? Now, by now, you probably know what's in my particular energy basket. I mentioned a few of them as we spoke. I have a couple of pipelines, so Energy Transfer and Enbridge. I have a couple of energy stocks like Phillips 66, which has been an underperformer, and I also hold Exxon. So in my own portfolio, I have a basket of stocks, including XLE. So that's what I do. And you can let me know in the comments what you do. And whatever it is that you do, I hope it works well for you. And I wish you lots of success. Thank you for watching. Take care. Bye bye.